to another episode of the MD Investor, the channel where we talk personal finance, setting goals, achieving goals, increasing our financial intelligence and that of our children so we can finally break the cycle of generational poverty, right? We basically got sick and tired of being taken advantage of by everybody, and we decided to do something about it. So before we get into the new video, if there's people out there you think could benefit from the information, friends, family, colleagues, let them know about the MD Investor. On YouTube at MD Investor, and on Instagram at MD Investor 1. September, back to school month, we've done back to school basic fundamental lessons such as stocks, lesson on bonds, lesson on mutual funds, lesson on stock market sectors. And today's lesson is going to be on ETF, exchange traded funds. We did a video on mutual funds, and what you're going to realize in this lesson is that mutual funds, ETFs, index funds, they're all very similar. A few differences that is going to be highlighted and important to know, but they're all very similar. So if you've seen a lesson on mutual funds, you're pretty much ahead of the game. So let's get into it. ETF, what is it? Like I said, it stands for exchange traded fund. A lot of terms, but it's not really that complicated. Whenever you hear the word fund, F-U-N-D, an investment, it basically means a basket of stocks, such as a mutual fund, right? A mutual fund is basically a basket of stocks. It's not just one company like AT&T. A mutual fund has multiple companies. You might have AT&T, you might have McDonald's, you have multiple companies. And it's the same way an ETF or an exchange traded fund is an investment product with basket. It's like a basket. It has multiple stocks or bonds, right? Because you can have bond ETF as well. Multiple stocks or bonds in it. Okay, so let's talk about why would you want to have an ETF or some of the advantages. Like we said, for example, an individual stock like AT&T is very risky, right? If you have all of your money in one stock and something happens adversely to that stock and it goes down 100, now you have 100% of your money at risk. But if you had 100 companies and only one of them was AT&T and something happened to AT&T went down, you have 99 other stocks that are not affected. So you have spread out or diversified your risk. So having an ETF or mutual fund is a way to spread out your risk. Okay? So that's one of the first things. You may say, well, I can do that myself. I can just buy 100 stocks myself. Yes, you could do that. But think of the expense. Think of the time. Sometimes you may have to pay commission, right? It's just kind of cumbersome, and right, if you're going to do 100 orders, then you need to have at least the money to buy at least one share of each, right? One share of AT&T, one share of Home Depot, one share of Loud, one share of McDonald's, one share of Starbucks, and on and on and on. It's going to take you a lot of money. And the commission, if there is one associated with it, it's gonna the fees are gonna add up, right? And the research into all of the, so you can see it becomes kind of cumbersome and not really something easy to do. So with something like an ETF, you can buy one share of the ETF. The ETF have the holdings of all these companies. You buy one share of the ETF, and then now you are diversified. And that's one of the benefits of the ETF. You get immediate diversification. Okay, so like a mutual fund. We're talking about an actively managed mutual fund, which we don't recommend, right? We do not recommend actively managed mutual fund. Like an mutual fund, it is comprised of a basket of stocks. But unlike a mutual fund, an ETF is passively managed. Meaning basically just kind of, usually it's probably tracking an index. And we're talking about an index. It's basically maybe like a measuring, right? So you can have an S&P index, right? Maybe this is a index that tracks the 500 biggest companies in America. You may have the total stock market index. That's something that tracks the entire stock market index, right? So an ETF is passively managed. Actively managed mutual funds obviously are actively managed. They have portfolio managers in the mutual fund, and that's where the expense ratio is so high in the actively managed mutual funds. And because of that, it eats away at your return. Because ETF is passively managed, the expense ratio is smaller, and therefore you get to keep more of your money. Again, one of the advantages of the ETF, the fees are lower. Okay. Another advantage of the ETF is that there's lower investment minimums, and you're going to see that when we go into some specifics. There's lower investment minimums in the ETFs, and that allows you to get exposure to these great companies, be immediately diversified without that barrier to entry of the mutual fund. Sometimes there's a higher barrier to entry. For example, with some of the Vanguard mutual funds, you need at least $3,000 in order to get into the mutual funds. Okay, we're going to get into that a little bit. Another advantage of the ETF is that because they trade like a stock, right? It's called exchange traded fund. So the fund connotates is a basket of stocks or bonds, and the exchange traded mean that they trade on an exchange, on a stock exchange, such as the New York Stock Exchange or the NASDAQ. So it's a basket of stocks that you can trade like a stock on one of the exchanges. You can compare that with a mutual fund. Let's go down to this little chart here, and then you guys will see what I mean. So regarding ETF and mutual fund, so both are less risky than investing in individual stocks and bonds. We kind of went over that, right? Because with individual stocks, everything is concentrated into that one company. With ETFs or mutual fund, they're spread out. You have your holdings that are more spread out. Both ETF and mutual funds both offer a wide variety of investment options. We kind of talked about that, right? And it's not just stocks. Let me add, there are bond ETFs as well. Okay. And there are bond mutual funds as well. Both are overseen by professional portfolio managers. We said with the actively managed mutual funds, the portfolio managers are trying to beat the market, right? Trying to see what company is going to succeed, and the companies they think are going to succeed, they want to buy more of those. The company they think they're going to fail, they're going to try to sell them. So they're constantly selling and buying, trying to outperform the market. And because of the active manager involvement, the team of people doing research, your expense ratio is higher. And because of that, it eats at your returns. Even if the performance is the same, because the expenses is higher on actively managed mutual fund, it's going to suck money out of your account and your performance eventually will drag or lag. Even if the actively managed mutual funds are able to beat the market maybe for a few years, over the long term, they are not able to do it. They say 95% of actively managed mutual funds are unable to consistently beat the market. Even Warren Buffett said, just buy the market. And that's where it says here, both are overseen by professional managers. With the ETFs, they're not trying to beat the market. They're just trying to mirror the market. That's why when you read in the portfolio or in the prospectus, the prospectus basically is like the handbook of what the objective of the fund and so on. They'll say they track an underlying index. They're trying to match it. They track it. We're not trying to beat the market. We're just trying to be or mirror the market. And because of that, we're not actively selling, buying, and all this stuff. And because of that, the fees are much lower. Okay? All right, let us look at some of the differences between ETFs and mutual funds, a little review. So if you prefer lower investment minimums, and ETFs could be suitable for you. Why? Because to get into the ETF, all you need to do is be able to afford one share. That's it. If you have the money to buy one share of the ETF, you're in. If you prefer a lower investment minimum, a mutual fund may not be suitable for you. Like I said before, a lot of times these mutual funds have a minimum or threshold investment. For example, it says here most Vanguard mutual funds have a $3,000 minimum. Okay, so what that means is that without $3,000, you're unable to get into some of these Vanguard mutual funds. Okay, you're unable to get into some of these Vanguard mutual funds without the $3,000. And by these Vanguard mutual funds, they also mean some of these. They include index funds in that as well. Let me add this. With Vanguard, you do need a $3,000 minimum in most of these mutual funds. But after that, you are able to set up automatic investments that could be lower than that. Example, you can say put $3,000 into a Vanguard Total Market Index Fund, which is a mutual fund. That's passively managed. You got your $3,000 in there, and then after that, you can set up recurring investments for, say, $100 a month. But to get in initially, you need that $3,000. So because that $3,000 could be a barrier to entry for a lot of people, they may not be able to do that at this point. But if you can afford the price of one ETF, they usually have a corresponding ETF that matches that index fund. Okay? If you want more hands-on control over the price of your trade, an ETF could be a suitable investment. So let me say this. Because the ETF trades like a stock, meaning, stocks, there's a fluctuation, 1 hour, it's trading at $30. And then another minute, it's trading at $28. And there's like fluctuation throughout the day of the price that you actually get in. So it is for an ETF, right? So if you say, I do not want to buy that until it gets to be $25. You can watch, or you can put maybe a limit order saying, when it gets to $25, buy. So you can have a choice of the price you want to buy it at. You don't have that with a mutual fund. With a mutual fund, no matter what time your order is put in, right? The market opens at 9:30. I think they close at 4:30. You put your order in at 10 a.m. to buy an ETF. You're going to get it at that price, or you want to sell it. You will sell it whatever the price is at that moment in time. Contrast that with a mutual fund. You put an order in to buy a mutual fund at 10 a.m. Another person put an order in to buy the same mutual fund at 2 p.m. The order will not go through for either of them until the end of trading on that day. They do their calculation or whatever, and they figure out what is the NAV, or the net asset value, which means what is the value or the cost of this mutual fund today. Whatever that they decide that price is today, that's what you're going to pay, whether you're buying or selling. No matter if you put your order in at 10 a.m. or 2 p.m. So you really don't have that choice in terms of the price you're going to actually pay. And we kind of reviewed this here already. If you want to repeat specific transactions automatically, an ETF wouldn't be a suitable investment. Meaning, if you want to contribute $100 every day into this ETF, you cannot do that. You can't set up automatic payments like that. You'd have to buy that ETF, whatever the price is trading at that specific day. And you want to do it every month, then every month you got to put the order in. Every month you have to put the order in, and whatever the price is, that's what it's going to be. But with a mutual fund, you can do it. You can't set up that automatic reinvestment every month. Okay, as long as you met that initial threshold. With Vanguard, we said it was about $3,000. Okay, let us look at some specific ETF. Okay, let's see. Let's go up and see if we can look at the different ETF. And we said before that We said that ETFs are basically a basket of stocks, and there are tons of them, right? What I want to do is I want to find okay, this is what we're trying to find. So we said ETF is a basket of stocks. It could be a basket of stocks or bonds. Now, this is the power of ETFs. You can have all different types of ETF. We did the lesson on bonds, right? Now look at Vanguard here. It said there's 74 matching ETFs, right? There's bond ETF, which is a basket of stock. We did bonds, right? Our lesson on bonds. We said they are government bonds, right? Like treasury bonds. So here is an ETF that said extended duration treasury ETF, which means that there's a basket of stocks that have government bonds and they're extended duration, meaning they're probably not 1 or 2 years, they're probably 20, 25, 30 years. So you get a basket of those. Intermediate term bond ETF. So you get this one, and it's going to be a basket of intermediate bond ETF, maybe 10 years, 15 years. And these are not government bonds, right? Because if it was government, it would say treasury. So you can see the different variety we have, okay? Here is a total bond market ETF. So it has a little treasury bond, a little corporate bond, and it's a basket of them. Here is Vanguard's offering for investment grade or corporate bonds. So intermediate term corporate bond ETF. So they're the intermediate term, maybe 10, 12, 15 years, and they're corporate bond ETF. And it's a basket of them. Here's long-term corporate bond ETF. So these are probably 25, 30 years, and they're corporate bonds. Short-term, and here's a total corporate bond ETFs. Here is a tax-exempt bond ETF. Meaning if you buy this, it's going to be a basket of bonds that are tax exempt, right? So just for the fun of it, let's just kind of look into it. Let's click here, and then let's click here. Let's look at the tax exempt bond ETF. Let's see what is in it. Vanguard tax exempt bond ETF. Okay, let's see what's in it. Now they say here there is some AAA bond, which is probably the best. AA, they are very low risk. A, and there's only a very few of the lower grade bonds. Okay? Let us go back. Now, this is what I want to look into. Look at the stock ETFs. That's kind of what I want to look at. The U.S. stocks ETF. Again, these ETFs are going to be, here it says large cap. These are large cap stocks, and they're a basket of them. Depending what you want, the words will describe it. Dividend Appreciation ETF. So obviously this ETF is a basket of stocks that is more looking for stocks that probably have increasing dividends. If that's something important to you, that might be something you may want to look into, right? Growth ETF, right? Basket of stocks that are more interested in growth. These companies have grown. High dividend yield ETF. You're looking for stocks that are have higher than average dividend yield. There's a basket of those stocks. Okay, let's look at the one that I want to look into. Total Stock Market ETF, or VTI. This is Vanguard's offering for total stock market, right? You have everything. You have the S&P 500 index, which is the 500 biggest companies in America. You can have an index or ETF that tracks that. This is Vanguard offering for that. VOO is the S&P 500 ETF, so it tracks the 500 biggest companies in America and it matches that. That's VOO. You can do the Vanguard Total Stock Market, which will include not only the 500 biggest companies in America, but also other companies that are medium sized, other companies that are um, small, or other large companies, maybe they're not in the top 500, but they're there. So you have the total stock market exposure. Before we dig a little deeper into the total stock market, let's go down here. Look, you can have mid cap ETF, right? So these are medium sized companies, right? I think these will probably be somewhere between like 2 and 10 billion. And there's a basket of those. Okay, so you see the tremendous variety depending on the exposure. Small cap, these companies are probably anywhere between up to about $1 billion, right? They're small, they're not as big, they're probably growing faster, and you can get exposure to those. In addition, international bond ETFs, right? So companies or bonds outside of the U.S., you can get exposure. That's tremendous, right? Look at let's look down here for you can also have specialty ETFs. So you want to get exposure to the communication services, right? You're like, yeah, I own AT&T and Verizon, but I want to be exposed to the entire market. Well, you can go to this ETF and it'll give you a basket of stocks that are in the communication services. Likewise, a basket of stocks in the consumer discretionary. Right? So they'll probably have stuff like McDonald's, maybe clothes, retailers, consumer staples. That'll be stuff that you need. So basket of stocks that does like food, maybe by Walmart, Target. It's probably in there. Stuff that's really necessary. Procter and Gamble. It's this company that makes soaps and detergent. Energy. So this have all the multiple gas companies, financials, all the banks, all the basket of stocks, including the banks, including insurance companies, healthcare. So you get to see the tremendous amount of variety. Okay. Now let's go back to our total stock market, because what I want to show you is the power here and of the diversification. And then we'll call it a day. Total stock market ETF, VTI. All right, so total stock market VTI. You see here where it also says also available as an Admiral Shares mutual fund. But then you're gonna need at least $3,000, right? If you don't have that, you can say, well, I don't have the $3,000 for this the total stock market ETF, but all I need to get the ETF version is the price of one share, which as of the close of market on September 18th is $169.11. If you have that, you can buy one share of VTI, and you're gonna see the great diversity and exposure you get. You see here, it seeks to track the performance of the CRSP US Total Stock Market Index. That's the index of all of the investable equities in the United States, all companies, the 500 biggest, the medium, the small, all of them. And that's what it says here, large, mid, and small cap equity diversified across growth and value styles. Employs a passively managed index sampling strategy. When we see passively managed, that means it is following an index. It's not actively managed. Passively managed to be compared to actively managed. It's cheaper, it's better. Okay, low expenses, minimizing net tracking error. The expense ratio is only 0.03%, which is excellent, meaning you're only going to pay 30 cents for every $1,000 you have invested. The risk potential is more risky because it's all stocks. There's no bonds. Okay, let's look at the top 10 holdings. Oh, before we get to there, look at the blue is the total stock market ETF, which is the VTI, and the beige is the benchmark, right? The benchmark. And you see how it's pretty much identical. It's identical because it's matching it perfectly. If you had invested $10,000 in 2010, right now it would be worth about $40,000. And the reason why it matches it perfectly, this is the benchmark index, right? So the total stock market, it said, at about 2%, it's weighted about 2% in basic materials. So they picked the ETF and they made it identical. It's 8.30% consumers foods, so they make the ETF the same. And you realize everything is identical. It matches it perfectly. That's why you are the market. The market goes up, you go up, because you're just like it. The market goes down, you go down. It's just like it. Top 10 holdings. Here you are. Apple, Microsoft, Amazon, Alphabet, Facebook, Berkshire Hathaway, Johnson & Johnson, Tesla, Visa, Procter & Gamble. That's your top 10 holdings. Okay? But this is what I want you to look at. And you're going to realize the power. It says here, in VTI, there are almost 3,500 holdings. In this one ETF, you have almost 3,500 companies. Can you say you're diversified? You are well diversified. Let's look at this first page. So we did the first top 10 already, right? Did the number of shares the ETF holds and the market value. So Apple, Microsoft, Facebook, Amazon, Alphabet, Johnson & Johnson, Berkshire, Tesla, Visa, Procter & Gamble. In addition, MasterCard, all right? Home Depot, United Health Group, JP Morgan, okay, Verizon. So you have communication, PayPal, Walt Disney, you have entertainment, you have Netflix, you have Salesforce, you have Merck & Company, AT&T, Pfizer. You see, you have everything. You have financials, you have consumer staples like Walmart and Pepsi. And that's only 30 of 3,400. Obviously, we're not going to go through all of them, but I just want to show you the power. You own the market. When the market goes up, you go up because you are the market. Abbott Labs, you own it. Coca-Cola, you got it. Exxon, you own it. AbbVie, you got a piece of that. McDonald's, you got a piece of that. Chevron, you got a piece of that. Costco, there is nothing that you won't own. You own the entire stock market. Can you imagine if you had to buy one share of all these companies? That's why it's very convenient. If you had to buy one share of all these companies and then pay the commission and trade commission and all this stuff, do all the research now. You own Starbucks, you own 3M, you own Lockheed Martin and Raytheon Technologies and Boeing, Wells Fargo. You own the entire stock market, CVS. You own everything. Look at it. Some of these companies you know, some of them you're not going to know. This is the power of diversification, guys. This is the power of the ETF, okay? But like I said, some of the downside you want to remember before we go over the downside. So passively managed, just like an index fund, because actually they're both mutual funds. So ETF and index fund, they're both mutual funds and they're both passively managed. The difference between the index fund and the ETF is that the index fund you cannot buy, you cannot trade it. The price doesn't fluctuate day by day and all these things. The big difference with the index fund is that you can almost do a set it and forget it, right? There might be a higher barrier to entry, maybe $3,000. Then you can say put it on autopilot, right? $100 a month or whatever. With an ETF, you can get the same exposure in one share. You can't do an automatic monthly stuff, but you have every month you have to buy. But except for that, the fees are low in the ETF and the index fund. It's a little higher in the actively managed fund. There are lower minimums for the ETF, and the prices for the ETF may fluctuate because you can trade it like a stock. With the mutual funds, actively managed mutual funds, the trade doesn't go through until the end of the day when they determine the net asset value or what the fund is worth at that time. ETF is passively managed, just like an index fund, and those are contrasted with actively managed mutual fund, which are trying to beat the market. ETF and index fund, we're just trying to mirror the market, okay? So guys, just another video, guys, to increase our financial IQ, to increase our financial knowledge, to teach our children so we can finally break the cycle of generational poverty. Remember, the key to all these videos is not just to absorb the knowledge, but to take action. So, and let me just add this. I showed the Vanguard product because I like Vanguard, but you can get the equivalent stuff in Fidelity and all these other platforms, okay? You look for a total stock market ETF, and you can see what version they have, and that will give you the same exposure. It'll probably also have a low expense ratio. The past is gone. We can do nothing about it, but just learn from it. The present is here, and we have to use the time to plant seeds so we can enjoy an exceedingly and abundant harvest for all our hard work under the sun. Remember, there's people out there you think could benefit from this video. this financial knowledge, let them know. And I will see you on the next one.